We like to think that money is just a tool, a way to trade goods and services. But the truth is far more unsettling. The modern financial system isn't neutral. Behind the scenes, an invisible web of power decides who gets access to money, who can borrow, and who can prosper. That web is controlled by central banks, and their influence stretches far beyond the economy. It shapes politics, global markets, and even the very way we live. To understand it, we need to go back to the moment when central banks first began consolidating power and see how a handful of institutions quietly began controlling the world. The story begins in 17th century Europe. In 1694, the Bank of England was founded. On the surface, it was just a bank. It would lend money to the government, issue banknotes, and stabilize the economy. But the reality was more profound. By lending to the state, the bank gained the power to influence fiscal policy. Every time the English crown needed funds for war, the bank controlled the terms, effectively deciding which nobles, merchants, and regions would benefit and which would suffer. What started as a simple institution for managing debt became a mechanism to shape the nation's priorities and power structures. Other nations quickly followed suit. France had its Banque Royale in the early 1700s, and Sweden, the Netherlands, and later the United States established their own central banks. The pattern was the same. Governments relied on these banks to finance wars, expansion, and infrastructure, creating a dependency that gave central banks enormous leverage. By controlling the money supply, they could indirectly control inflation, interest rates, and credit availability. Those who held influence over these banks weren't just bankers. They were architects of national and global power. The 18th and 19th centuries revealed just how far this control could extend. Consider the Napoleonic Wars. Entire European economies were reshaped by debt. Governments borrowed heavily from private banks, and these banks in turn controlled who could access capital. London and Paris became the nerve centers of global finance. Countries that defaulted or mismanaged debt were punished not just economically, but politically. Wars were funded, colonies expanded, and markets shifted, all under the influence of central banking networks. A small group of financiers could, indirectly, sway the fate of entire nations. Fast forward to the 20th century, and the story takes on a new scale. The Federal Reserve in the United States, created in 1913, was designed to stabilize the economy, but it also centralized the power to control money in the hands of a few. During the 1920s, easy credit fueled a stock market boom. Speculation ran wild, and when the crash of 1929 came, the Federal Reserve's policies determined the severity of the Great Depression. Some survived because they understood the mechanisms at play. Most suffered because they were blind to the invisible hand controlling liquidity and credit. The lesson was clear. Central banks weren't just observers, they were players in a high-stakes game with global consequences. During the post-World War II era, central banks became even more influential. The Bretton Woods system, established in 1944, tied currencies to the US dollar, which itself was backed by gold. This arrangement placed the Federal Reserve at the center of a global financial network. Decisions made in Washington rippled through Europe, Asia, and Latin America. Nations dependent on dollar reserves had to align policies with US monetary policy, whether they wanted to or not. Through this network, central banks could influence inflation, trade balances, and capital flows worldwide, effectively controlling the levers of global economic power. But influence isn't just about economics, it's about perception. Central banks shape expectations. By raising or lowering interest rates, issuing warnings about inflation, or signaling quantitative easing programs, they guide the behavior of investors, corporations, and governments. A single statement from the Federal Reserve, the European Central Bank, or the Bank of Japan can move trillions of dollars in minutes. This power is subtle, invisible, and often misunderstood. Ordinary citizens rarely notice it until it affects their mortgages, savings, or job prospects, but the effect is profound and far-reaching. The 2008 financial crisis is a perfect example of this control in action. When banks collapsed, central banks became the ultimate arbiters of survival. The Federal Reserve injected liquidity, the European Central Bank coordinated emergency lending, and governments followed central bank guidance to bail out institutions deemed too big to fail. The crisis exposed the symbiotic relationship between central banks and global finance. Those who understood it could navigate the storm. Those who didn't were left with losses that took years to recover. The lesson is simple but chilling. Control over money is control over outcomes. Even today, central banks are expanding their influence in new ways. Digital currencies, open market operations, and cross-border swaps allow them to reach further and faster than ever before. Their decisions determine not only inflation or employment in a single country, but the flow of capital around the globe. Emerging markets, dependent on foreign reserves and global trade, are especially vulnerable. A policy shift in one central bank can trigger currency crashes, debt defaults, or political instability thousands of miles away. The reach of these institutions is nearly total, and most people have no idea how much power they wield. Here's the uncomfortable truth. Our financial freedom is limited by the invisible authority of central banks. They decide when credit is cheap or expensive, when economies boom or contract, and who benefits from systemic crises. If you measure your wealth in currencies, stocks, or real estate without understanding this power, you're effectively playing by rules someone else wrote and losing the advantage before the game even begins. So what can be done? Understanding the history and role of central banks is the first step. Recognize that money is not neutral. It is a tool wielded by institutions with interests and agendas. Diversify the forms of value you hold: productive assets, essential commodities, skills that can't be automated, and knowledge that retains utility even if currencies fluctuate. When markets wobble, tangible assets and transferable skills endure. History repeatedly shows this is the difference between survival and collapse. Ultimately, central banks control the framework in which wealth operates, but they cannot create intrinsic value. That belongs to you. Land, resources, skills, and networks retain usefulness regardless of monetary policy. Understanding this distinction gives you an edge that no bank, no market, and no political shift can take away. Central banks were originally created as tools for governments to manage debt and stabilize national finances. Over the centuries, however, their influence has grown far beyond simple debt management. Today, they quietly govern global finance, shaping interest rates, currency values, and economic stability in ways most people never notice. Their decisions ripple through markets, businesses, and everyday life, affecting jobs, investments, and the cost of living. Despite their subtlety, the effects of central bank policy can be enormous. Quantitative easing, rate adjustments, and currency interventions can create booms or trigger crises. Investors and citizens often see only the outcomes: stock surges, inflation, or economic slowdowns, without understanding the mechanisms behind them. The lesson is simple but critical. Protecting your wealth isn't about following numbers on a screen. It's about focusing on assets that hold real value, skills that remain in demand, and resources that remain useful when economic conditions shift. These are the foundations of financial resilience. History reinforces this point. From the establishment of the Bank of England in the 17th century to the creation of the Federal Reserve in the 20th, from managing empire finances to responding to modern global crises, central banks have consistently influenced who thrives and who struggles. Recognizing their role helps you make informed decisions rather than reacting to events after the fact. If this helped you see how central banks shape the financial world, subscribe to stay informed. Learn how money really works, protect your assets, and build lasting value, even when the unseen forces of global finance are at play.